Today's economic data that came in better than expected for PPI, that is producer price inflation. Technically, producer price index, think of it as the producer's inflation. Now, CPI is consumer price index or consumer price inflation. PPI tends to lead CPI because, after all, if you're a company and your prices or your cost are going up, you're going to pass that cost on to consumers. We get that data, CPI, out tomorrow morning. But today's PPI came in much better than expected. And this has a lot of people actually calling for recession. Just take a look at CNBC today. Piper Sandler says, we forecast a recession, which will slow inflation. This clip says investors need to be cautious about buying stocks amid real recession risks. This is Morgan Stanley. You have others, like this individual with stifles that says there is a risk of a bear market if the slowdown becomes a recession. Part of the reason for more recession calls today is the data that came out. PPI coming in lower than expected. Great. That's awesome. Okay, companies are feeling less pressure on inflation. But if that translates into CPI, and perhaps with the CPI numbers that we have seen in recent months actually being close to deflation on month over month metrics, if we actually start to get deflation, that's worse than inflation, because deflation means companies bring in less money, not just keeping costs stable. That means companies are actually lowering prices to drive demand. And that means less revenue that company brings in, less profitability, less workers that company is going to employ. So people start to get fired, and that feeds into the broader economy. So deflation is actually a big negative. So PPI month over month came in at 0.1%. We were expecting 0.2%. So it came in on the low side. That's great. Again, as long as CPI doesn't come in deflation, then I think this is good news. Core PPI month over month came in at 0%. We were expecting 0.2%, so that was a big beat on core month over month. Last month's core month over month came in at 0.4%. It was revised down to 0.3% today, so that was also great news. Core PPI year over year came in at 2.4%. Last month it was at 3%, so that's a massive drop. We were expecting 2.7%, so just great numbers there as well. And if you look at PPI year over year, that came in at 2.2%. We were expecting 2.3%, and last month was 2.7%. So these are not small drops you're seeing. These are huge drops in PPI month over month, as well as year over year. Much more than expected. The S&P 500 at the time of recording this video is up 1.4% today. So markets are definitely taking this as good news. And until we get retail sales on Thursday, I think CPI is probably going to be good tomorrow. We'll look at the expectations for CPI here in this video, my thoughts around that. But PPI is a pretty good leading indicator to say CPI is also going to come in pretty low. The only thing that matters right now for investors is retail sales, consumer spending data. How is the consumer holding up? Is this just a consumer discretionary recession? Or could this spill over into a broader problem? Liz Young Thomas on X, she is the head of investment strategy at SoFi, puts it well. She says the PPI trade services month over month print was the second lowest on record. This attempts to measure wholesale and retail margins, suggesting a meaningful decline in profits. More of this would not bode well for earnings in coming quarters. And you can see the decline here. Ryan Dietrich on X says, let's repeat, inflation is last year's problem. We've been saying this all year, meaning this year's problem could be the economy, and that's why it is so important the Fed recognizes recognizes this and starts to cut. Peter Burskin on X says, nice pop in the NFIB survey this morning. The level is now consistent with a mere recession rather than a full-blown depression. Meanwhile, economic uncertainty is at post-pandemic high, and a net 16% of respondents said sales declined over the past 3 months, 4 points worse than in June. Great. Goldman Sachs just said this about buybacks. They say August to September buyback season is the second best of the year. Window for buybacks has now reopened with an estimated $1.15 trillion worth of authorizations. That's trillion with a T. Nick Timmerhouse writes on X, there are a few other charts from the New York Fed consumer panel that says just 30% of Americans expect their financial situation will be better over the coming year. That's up from the September 2021 through December 2023 lows, but down to its lowest level in 2024. So consumers still, they don't feel very confident on the economy. I mean, after all, why would you? Unless you're in stocks, and specifically index funds that track the S&P or the NASDAQ, why would you feel good about the economy? Everyone I talk to says the economy sucks, from a lot of middle-income Americans. Now, let's take a listen to this clip that says, we forecast a recession which will slow inflation. This is according to Piper Sandler's Nancy Lazare. What's interesting about this is Piper Sandler is sometimes called Pumper Sandler because they tend to be optimistic with price targets. They tend to kind of pump up stocks in a way. So I find it very fascinating that they are forecasting a recession now.
Us this morning is Piper Sandler's global chief economist, Nancy Lazare, also one of Barron's 100 most influential women in finance this year. Nancy, it's great to have you. Thanks for being with us.
Thank you for asking. Nice to see you.
Does today's number prod you to adjust any forecasts?
It really doesn't. We've been expecting inflation to cool, and indeed there's been a package of data this week along with a PPI reading. We had the New York Fed consumer inflation expectations reading yesterday along with the small business inflation outlook. And so this just continues a trend of cooler inflation because the unemployment rate is increasing. It's not immaculate disinflation. We think it's because you are seeing a clear underlying weakness in the labor markets.
So does it allow the Fed the room to keep the focus on employment? And what do you think the calculus is right now for employers when it comes to hiring?
Well, corporate revenues are getting squeezed. We've seen it in a lot of the company comments during the second quarter earnings season. We think 3Q is going to be even more difficult. They're seeing their profit margins. Companies are seeing profit margins decline, in particular if you X out the Magnificent Six. And as a result, companies are trying to protect those profit margins, and they're doing that by increasing layoffs, not hiring. The rehiring rate is down sharply. And so that's leading to weakness in the labor markets, which is leading to weakness in consumer spending. Again, we've got some of the earnings news out this morning. And as a result, that's putting downward pressure on companies' ability to hold price, forget about raising prices. They're going to try, but net prices are going to be under a lot of pressure.
But where do you think that goes? What does the shape of the unemployment rate look like? Is it just going to be like a slow rise? Is there a risk of a spike?
Yeah, we think we're entering a normal recession. By that, I mean GDP goes down about 1%, consumer spending declines about 1%, because the unemployment rate increases about 250 basis points. So right now, it's kind of a slow grind and still a huge debate on whether or not it's really increasing. We've laid out plenty of different data sets that do suggest the unemployment rate is increasing. Again, just ask Home Depot. And so at the end of the day, it's going to be a gradual rise, but classically, it does lead to a spike as you really see downward pressure on earnings. Companies really start to increase layoffs, and layoffs are starting to increase, but they probably will intensify as we go into the fourth quarter, taking the unemployment rate up towards 5% by the end of the year.
You just casually dropped the recession word, Nancy, which, it hasn't been the consensus. And even with sort of increased forecast for higher unemployment, most of your fellow economists think we can get away with a soft landing, and so does the Fed at this point. GDP is tracking, according to the Atlanta Fed, for this quarter, 2.9%.
Well, we think it's going to be weaker than that. We have our own GDP barometer, and it deteriorated quite sharply as we move through July and into early August. We'll get more better data on that later this week with retail sales. Second, if you look at historically, on average, it's taken 10 quarters after a Fed rate hike to move the economy into recession. Here in the third quarter of 2024, it is the 10th quarter, so we think we are now seeing greater risk of a recession unfolding. And then third, we have our own leading indicator, and it is suggesting that indeed the unemployment rate should be rising. And the leading indicator is based on things like the yield curve, just higher interest rates, money supply, housing, and they are all pointing to, no, this is just not a temporary blip in the unemployment rate. It is the beginning of a rising trend as the lagged effects of the Fed tightening cycle really start to squeeze corporate revenues, and that then leads to weaker employment initially, higher unemployment eventually, and then that really squeezes consumer spending. Again, just look at the companies. One of the things I constantly remind myself of is economic data are company data. And I've been keeping really close track of what companies say. I know nothing about them fundamentally, but I look at their revenues on the industrial side, on the consumer side, on the housing side, on the consumer goods side, service side, hotel, restaurants. There's a lot of negative commentary, and we're just moving into the retail season. And so this is going to be also very interesting as a picture of what the underlying trend in consumer spending is doing. And why are they shifting down? Because it's more difficult to get a job and wages are slowing.
Holy smokes! I bet you didn't expect a commentary like that. That's so sharply different from anything you hear from the Wall Street perspective. I think it's valuable to have a balanced intake of the information that you consume. If you only listen to bulls, then you're going to be bullish, even when now is probably the time in which risks are rising that threaten the bull thesis. Now, could this be just a rolling recession? Of course, it's clear. If you are a company that sells discretionary products, look at Nike, look at Five Below, look at Starbucks. Yes, Starbucks is having a great day today, but look at all of these discretionary companies. They are down and out. Okay, a lot of them are sitting at or below even the COVID lows. Okay, there is clearly a discretionary recession out there. Question is, does that actually squeeze company margins? Are companies able to raise prices anymore? Does a little bit of deflation start to creep into this economy? If you're middle America, you're gonna love that. If you're not in stocks, you're not in equities, that's great for you if you're a saver. If you're in stocks, if you're investing and buying companies, that's not great for those companies. That's not great for the overall economy. A little bit of deflation I think we can manage, but if we get something larger, which the velocity of the drop in inflation would suggest that at least some deflation is coming, that would in turn start a larger problem for companies. Because I think she made a great point in that clip. In this market, do you think a company is just going to let their margins deteriorate and not do anything about it? No, they're going to start firing people. They're going to start laying people off. Okay, that's what's going to happen. If indeed margins come under more pressure in the next 3 to 6 months, it's very well possible that could happen. And as Quentin here on X says, this chart keeps me up at night. What does Warren Buffett know that we don't? And that's true as well, okay? There's clearly some information that Warren now has that we don't, okay? I don't like to be super fictional in terms of having a tinfoil hat or conspiracy theories or whatnot, but something drastically changed at Berkshire Hathaway in the last quarter. I don't care about the SOM rule. I don't care about the inverted yield curve. I don't care about inflation or retail sales as much as I care about what Warren Buffett is doing. Okay? That is the biggest rise in the cash levels you've ever seen at Berkshire Hathaway. Ever. I mean, it's up 30% in a quarter. That only happens if he's expecting substantially lower stock prices. And Warren Buffett is somebody that knows a little about everything as far as the consumer. Obviously, he's big in insurance, but the consumer owns many different companies. Owns the company that owns Dairy Queen, for an example. Delicious. You get the chocolate chip cookie dough, put the little cheesecake pieces in there. Beautiful. Oh, so good. I'm probably gonna go get one after this video. But point is, he's seen something. That's it. Something more dramatic is coming. The timing on that is the difficult part. Buffett, he could wait a year or two, right? A lot of people don't want to wait 2 or 3 days to deploy their cash. So I think the timing's the most difficult aspect of this. But if you start to get data like on Thursday's retail sales that suggest the economy is slowing further, I think investors will react sharply negative to that. I think recession risks, recession odds will start to rise, and it will really put that on people's radar. I mean, again, just when inflation goes up, that tends to be a good time for the economy, just historically speaking. That tends to lead wages to go higher. It tends to lead to more corporate profitability. When you get inflation that falls, that tends to lead to the opposite effect. That tends to have a negative impact on the economy. In fact, the only times we've ever seen deflation ever in this country is during recessions. Like literally ever. 97% of CPI reports have been higher, right? Not in deflation. Only 3% of CPI reports in the history of the United States have actually been deflationary. And out of those 3%, all of them have been during recessions. So I don't know if we get a deflationary inflation number tomorrow, but if we do, that may not be seen as a big positive by Wall Street. Not like you would think. Because just again, to reiterate, deflation means lower corporate profitability. That means lower economic activity. And historically speaking, that would be like the greatest recession indicator that there is, period. Depot reported earnings today, and they cut their outlook for sales amid signs that tight interest rate policy is slowing demand. They say categories like kitchen, bath, lighting, flooring, all these categories that are components of larger projects have seen the greatest degree of softness. And the other important earnings for this week will be Walmart Thursday pre-market, coincidentally, the same time that we are getting retail sales. So if Walmart has remotely anything negative to say about the consumer, I think Wall Street's going to pay very close attention to that. Vice versa, if they say the consumer's still spending money, they're getting healthier, things are doing okay, then I think the markets will really like that. With that said, Nick Timmerhouse does put out this detailed expectations list from your banks for CPI every single month. Now, the median forecast has headline CPI coming in at 0.2% month over month and 3.0% year over year. The median forecast for core CPI is 0.19%. So higher than PPI, higher than last month by quite a bit. Last month came in at 0.06%. So very low. So we're expecting a jump from last month's low numbers. And year over year CPI for core is expected at 3.2%. So the lowest estimate is from Namara Bank. For core, you're expecting 0.08% from them. The highest estimate is from Bank of America, and they are expecting 0.22%. So following last month's surprisingly low CPI, the estimates are all over the place. Namera, again, at 0.08%, but you can also see TD Securities at 0.14%, Wells Fargo, 0.17%. Piper Sandler 0.21%, Morgan Stanley at 0.19%, Jefferies at 0.19%, Goldman Sachs 0.16%, Citi at 0.18%, Deutsche Bank at 0.2%, Barclays 0.21%. So expectations are kind of all over the place for tomorrow's CPI report, but it's pretty safe to say anything higher than like a 0.21 is going to be seen as probably bad news, right? Technically, anything over 0.19% will be seen as bad news. But I think the markets, they're not as worried about CPI at this point, okay? Now, anything lower than 0.10% is going to be good news, really good news. Anything that's negative might actually be bad news. Again, because of that correlation between economic activity, profit margins, and inflation. Now, again, beyond that, retail sales is the important catalyst. We are expecting 0.3% month over month. That's a positive 0.3%. Last month, we were at 0%. So this would be growth on a month over month basis in retail sales. If this comes in negative, that would be a big problem. Export prices are expected to be negative as well, 0.1%. Import prices expected to be positive, 0.1%, maybe a 0% number there. So that will affect your GDP estimates. And then you will also get initial jobless claims expecting 235,000. Last week's number was 233,000. And that's another important metric the markets are paying attention to, because that's really the leading indicator for the labor market. You will also get a lot of Philly Fed data, New York Empire State manufacturing data, continuing jobless claims, export-import prices year over year, as well as a lot of Philly Fed data like prices paid, new orders, employment, capex, and business conditions. So all of this data is going to feed into a narrative of, is the economy weakening? Is it doing okay? Are we going into a recession, or are we not? And that's really the main story of this week. It is, are we going into recession or not? And again, just from my personal opinion, I do think CPI is going to come in lower than expected, and it will probably cause a bullish reaction in markets. I think we're getting close to that high end range that I forecasted over this weekend that I expected to hit this week. And that is that 50-day moving average. That's sitting at about $543.26 for the SPY. So potentially like $2 and some change left to the upside. I find it very hard to believe you're going to get back above that 50-day moving average and just continue to new all-time highs. I think we need to get better clarity on the economy first, on retail sales, and I think we need to get Nvidia earnings out of the way as well. We also have this Middle East situation that is brewing that could happen tonight. It's being reported from Anthony Blinken today that he is canceling his trip to the Middle East tonight. And last time that happened was when you had the last attack from Iran on Israel. So this can be, like I said, a short-term kind of fear event. I'm not expecting it's going to be anything that is material or long-lasting. In fact, if CPI comes in really good tomorrow, and let's say we do get this Iran attack overnight tonight, it wouldn't surprise me if the two kind of cancel each other out and we see a so-so kind of muted day in markets tomorrow. Anything's possible here. And I think the real risk, the real thing we want to be watching is the economy. These short-term, geopolitical conflicts, they come and go. But the economy, that's what investors are investing their capital based off of. Even inflation, I think the markets have come to the conclusion that inflation is dead at this point. It's gone. It's not something that they're really too concerned with. As long as inflation does not go higher and come in higher than expected, I just don't think better than expected inflation numbers are going to cause an outsized upside move at this point. Not considering there are concerns about the economy. And again, considering when CPI, when inflation comes in low, that usually coincides with a weakening economy anyways. Strat and Tom Lee are reporting today that of the 456 companies that have reported so far, 91% of the S&P 500, overall 79% are beating estimates, and those that beat are beating by a median of 6%. Of the 20% missing, those are missing by a median of 5%. On the top line, overall results are beating estimates by a median of 6% and missing by a median of 5%, and 58% of those reporting are beating estimates. So in all actuality, only 58% of companies are beating earnings estimates. That's not a great number for this earnings season. With that said, provide your context down below in the comment section. Let me know what you think all of this means for markets going ahead. Do you think that this bounce is going to be short-lived? Do you expect that we are going to come back down again? What do you think about this Middle East situation, about Warren Buffett's cash, about CPI coming out tomorrow? Just let me know your thoughts, generally speaking, on all of these topics. Hit the like button as well as subscribe to the channel, by the way, if you have not done that already. That is free 99. It costs you absolutely nothing to do so. But most importantly, enjoy the rest of your day, and I will see you in the next one.